Thank you very much. And thank you to the organizers for inviting me to join you at the Inclusive Finance India Summit. It's really an honor to be here with you this evening, this morning for you, and I'm very sorry that I can't be there in person. I've been asked to speak about responsible digital finance. So in the next 15 minutes, I'll explore the progress India has made on financial inclusion, some potential gaps we see in that progress, and a few thoughts on how India can protect against consumer risks. We should then have time for 5 to 7 minutes of questions and answers at the end before you go into your main sessions, which I'm sorry I won't be able to join you for. These are without a doubt exciting times for inclusive finance. Digital technology and new business models are completely changing our ability to reach poor and excluded households with financial services. In fact, thanks to COVID-19, they're changing the way we work, study, buy, sell, and access services. India has been at the forefront of this fintech revolution with a unique public-private model that's propelled it into the vanguard of finance and technology. Not only has India been a world leader in building digital ID, a world-class payment system, a large and successful microfinance industry, and a thriving e-commerce sector, it's done all of this with an eye to inclusion and ensuring a competitive landscape, rather than the winner-takes-all model that dominates in the rest of the world. There's much to applaud in what India has done to increase economic and financial inclusion, and this shows in the numbers. As is by now well known, India increased its rate of financial inclusion from 35% to 80% between 2011 and 2017, roughly the equivalent of adding 470 million new bank accounts in 6 years. That is quite simply an astonishing figure. A gender gap that sat at 9% in 2011 was reduced to only 3% in 2017, thanks to government intervention to get accounts into the hands of women. We saw transactions over UPI cross the 2 billion mark per month in October of 2020, which is double the rate of just 1 year earlier. UPI was, of course, put to the test in the early months of the COVID-19 crisis when India sent social payments to 428 million recipients of various COVID relief programs, and it passed with flying colors. I've spent the last 10 years working on building interoperable retail payment systems in emerging markets, and nothing I've seen compares with what India has achieved with UPI in a few short years. India has reason to be very proud of all of these achievements. But now that I've said all of that good stuff, let me tell you where I think India still has more work to do. First, I don't yet have a good sense of the those systems do no harm. Let me explain what I mean. Well, I think we can all acknowledge that UPI played an instrumental role in getting resources to poor families during the crisis. I still have nagging concerns about how accessible the banking and payments infrastructure is for poor households more generally. Of course, people will avail themselves to social payments in a crisis. They have few other alternative sources of income. But once the crisis is passed, will they use these new high-tech systems for anything? Growth in accounts, we know that usage rates prior to the crisis were low, with 39% of accounts reported as dormant in the 2017 Findex. Since the Findex was not run in 2020, we don't yet know whether those dormancy rates have come down as a result of the crisis. But to get usage rates up on a more permanent basis, providers will need to offer a range of products that are relevant and accessible to the poor. The crisis offers the opportunity to build on these new levels of comfort with digital. The question is there a business case for providers to step in with services that meet those needs? Because the scale of the Indian market has the potential to obscure something important, namely, whether these solutions are actually reaching the poorest. If we focus too much on congratulating ourselves for the number of accounts opened, the volume of transactions running over UPI, or the profitability of fintechs operating in India, we may miss a very important part of the story. Because the fact of the matter is, providers can create very robust businesses reaching the top 20% of India's population, which is an addressable market roughly the size of Brazil. The attractiveness of poorer segments drops off quickly without explicit government intervention, which in all likelihood is the reason a large proportion of those new bank accounts continue to be held in state-owned banks. Given that most poor people in India operate in the cash economy and are likely to lack access to the internet, the question of both a digital and a financial divide remains pertinent. In that context, one indicator that causes me concern is the relative lack of cash-in, cash-out agents, which in other markets have been a crucial interface for poor people between the cash and digital economies. According to the RBI, India has 1.1 million Keynote agents, although CGAP estimates this number is likely to be closer to 500,000 or 600,000, taking into account double counting and inactive agents. Even if we generously assume the larger number and that all those agents are active, this means there's roughly one agent for every 1,240 Indians. Compare this with Kenya, where there's an agent for roughly every 230 inhabitants. While it's true that India has more bank branches per capita than Kenya, it's still not clear to me that we have enough viable on-ramps to the digital economy in the right places to include all of India's poor. So I think we still have work to do to get a wide range of financial services accessibly into the hands of low-income Indians. Beyond that, I think there are important questions about the potential for harm from digital finance. And Africa offers some useful lessons on this. Like payments, there's another product that loves scale, digital consumer credit, and they often go hand in hand. In Africa, we've seen explosive growth in digital consumer loans that leverage mobile money subscriptions, often targeting low-income segments and charging astronomical rates. Zambia is a market where we actually have very good data on digital credit growth. Over a 3-year period between 2016 and 2019, loans dispersed to households grew 25 times, from tens of thousands of loans a month in early 2016 to nearly 2 million loans a month 3 years later. I appreciate that these numbers may seem minuscule in the Indian context, but bear in mind that the total adult population of Zambia is around 9 million people, and that 60% of these loans were made to households earning less than $5 a day. We've seen this play out across multiple markets in Africa, and regulators have struggled to measure this explosion in subprime debt, much less manage it. And the result in some countries has been a sharp uptick in rates of over-indebtedness and people being blacklisted for taking loans they didn't understand. As finance is increasingly embedded into other digital services like e-commerce and gig work, the opportunities for abuse multiply, making it even harder for regulators to ensure fair treatment. So how do we make sure that poor people's welfare is baked into this incredible period of expansion and access to financial services? I think there are 4 main pillars to an approach. First, we have to stay attentive to the risks of exclusion. Unless people have smartphones and bank accounts, they're likely to be excluded from the digital economy, or at least find it challenging to engage. We need to find ways to link the digital and the analog, with policies aimed at providing people with access to cash-in, cash-out points, smartphones, affordable data, and bank accounts. As increasing parts of the economy move online, we have to make sure that the digital divide does not grow. Second, we have to continually anticipate the risks that digital brings and be prepared to look for them in unexpected places. This covers traditional areas of concern like over-indebtedness, aggressive collection practices, predatory pricing, and fraud, but also encompasses entirely new areas of consumer risk like data protection and privacy, identity theft, and cybersecurity. We also have to contend with entirely new categories of providers, most of which don't do finance as their main activity and aren't regulated. For too many years, mobile network operators in Africa have ducked responsibility for the lending that passed over their channel, thinking that because they didn't take credit risk, it wasn't their concern. Except no one ever thought they were taking a loan from the lender. They thought they were taking a loan from the MNO. So from a business perspective, the MNO's reputation is on the line. And from an ethical perspective, they absolutely have a responsibility to their clients for fair treatment. Imagine how much more complex this equation becomes when loans are embedded in e-commerce purchases or are made available to gig workers. Third, one really good way of anticipating and tracking risks is to listen to customers. But many digital services make this extremely difficult to do, even for digitally savvy people. I recently tried to engage with PayPal to get a payment taken off hold and literally gave up after interacting with their circular chatbot for half an hour and just decided to wait it out. Most poor people don't have that option. There are many ways to listen to the voice of the customer. Providers should have robust redress mechanisms in place. That could be through a call center, a chatbot, or an interactive voice response system. And they should be prepared to react to consumer complaints. But beyond this, there's value in channeling the collective voice of the customer through consumer associations that interact with providers and regulators. Forward-thinking regulators like the FCA in the UK include consumer advocacy groups in regulatory advisory bodies so that their views are represented. Supervisors can also avail themselves of soup tech solutions to help surface issues or use mystery shopping, survey instruments, and transaction data analysis to identify emerging problem areas. Finally, the responsibility for consumer protection has for too long sat mainly with consumers. There's a need to ensure a balance of accountability between regulators, providers, and consumers. And regulators have an important role to play in making this happen, because we can't assume providers will adopt responsible practices on their own. CGAP advocates for regulators to take a proactive, customer-centric approach, requiring providers to report on how and whether customers have choice, whether service terms and conditions are clear, and that adequate recourse mechanisms are in place. CGAP's written about this outcomes-driven approach and is currently testing it with South Africa's Market Conduct Authority and several financial services providers. We're aware that DVARA is working with the RBI to help develop consumer rights in India, and I was encouraged to see that the RBI is establishing a working group on digital lending that will, among other objectives, recommend a fair practices code and consider whether the regulatory perimeter should be expanded to include digital lenders. CGAP will obviously follow their deliberations with great interest. But standards don't just have to come from regulators. Providers and associations can also develop codes of conduct. The GSMA did this for the mobile money industry several years ago and more recently instituted certification standards for compliance with the code. I'd love to see them extend the code to digital credit as the framework evolves. In closing, I'd like to acknowledge that we are indeed living in a time of remarkable change and dynamism in the delivery of retail finance. And the fintech revolution has seriously expanded our toolkit to bring meaningful financial services to the world's poor. But it also opens up many new risks for populations that have traditionally been excluded and marginalized. So the burden is on the financial inclusion community to make sure rapid innovation is matched by attentiveness to the accompanying risks. To make this truly inclusive will require a proactive effort to ensure that the poor have both viable on-ramps into the digital economy and, once they're there, are equipped to navigate it and have ample protections against the potential harms that can arise. Thank you very much. I'm happy to take a few questions from the audience. Okay, I think I'm meant to be reading them myself. So what are your top 2 recommendations for public sector government to be wary of while pushing the digitization agenda, especially focused on the poor? Let me think about that. I think most important is actually this ability to measure it. So when I was doing research on digital credit in Africa, and I stumbled upon this amazing data set that the Bank of Zambia actually had, I asked around to see if that data existed in any other markets like Kenya or Tanzania, where we knew that they had a problem. And it didn't. South Africa had it and Zambia had it, and that was about it. And if you can't see that you have a problem, you can't manage it. And I'm happy to say actually that Zambia does seem to have got that problem under control. I checked the statistics today and the number of loans to households has come down quite dramatically since the first half of 2019. So I think being attentive to what's likely to come and measuring it is a really important first step. But I think the other factor that's really important is really listening to customers. Like I said in my remarks, I do think it's important to bring those voices into the discussion. And I mentioned the FCA. They do have advisory bodies where they bring in groups that represent consumers. And I think that's a really important way of having a channel into regulators so that they can see, again, where the potential risks come. Because sometimes you just don't even know where they come from. I've heard stories, for example, of people taking loans that they didn't even realize they'd taken from e-commerce platforms, in fact, in India, and not realizing that they'd taken that loan until they defaulted on it, and they found out about the default by SMS. And so, as we increasingly see financial services embedded into other digital services, I think it's really important to have those channels of communication open so you know that there's an issue, because if you don't know there's an issue, you can't really deal with it. Okay, and then another question is, how should digital service delivery, agent networks, and person technology balance be improved for greater resilience, safety, and risk management? I'm not sure I understand the question correctly, but all of those pieces work together in any financial services model. So I think they all have to be in place. You know, we do a lot of work on agent networks. That's the cash in, cash out interface for people to get money into and out of the digital system. Those agents are your ears and eyes on the ground. So again, from a consumer protection perspective, that's another channel to get messages through. But I think all of those things actually have to work together. Technology alone isn't going to solve it. You can't put a product in place and just assume that people will understand how to use it, particularly if you're working with people who haven't had access to those kinds of products before. And again, it's a balancing act on the consumer protection side between regulators, consumers, and providers. They all have a responsibility to make sure that those services are safe. One comment that one of my colleagues made that I think is actually a really valuable one as well is thinking about products. So are providers getting products out to low income segments that are appropriate to their needs? And the person pointed out that, you know, nobody ever cut themselves with a razor because, you know, Gillette didn't explain to people how to use a razor. So there may be something about the appropriateness of those financial services and their intuitiveness for low income people who are using them. So I think there is something important as well about developing products that are suitable for poor people. And that, you know, is done by trial and error by providers putting that into the market. I think those are all the questions that have come in. Do we have other questions?
We have one last question just coming in.
What risk management changes should be implemented by digital financial services providers serving very poor, excluded communities in order to protect against local, regional, and global crises such as the COVID-19 pandemic? Yeah, that's a great question. I think we've all just had a crash course in preparing against black swan events. I can't speak to India, but I'm pretty closely following the situation in Africa, and I know there has been a huge shift to digital, where providers have had to very quickly ramp up call centers, ramp up their ability to communicate via SMS, ramp up their ability to operate via agents, either their own or third parties, contend with a lot of the challenges of understanding whether those agents could even operate. I think there has been a lot of learning about the power of associations, particularly in the microfinance space, to make sure that the industry's voice is heard. There was, in the initial stages of the crisis, a lot of relief provided to large lenders, and microfinance providers were forgotten about. And so I think a lot of the places where there were associations and places for the voice of those providers to get out has been important. Clearly, some of the measures that were taken by governments on debt moratoria have been really important for borrowers. But I think one of the things that we're going to find in the next few months is that we've got a bit of a ticking time bomb in terms of understanding what's going on in underlying portfolios of microfinance providers, because the way some of those moratoria were implemented meant that there were multiple rounds of rescheduling. And so I think we don't know what the level of damage is to some of those portfolios. But I think given the circumstances, we all sort of did the best that we could. But, you know, I think we've got ample experience with local and regional even crises. And, you know, there's been a lot of learning from that. And I would urge anybody who's interested to look at both the CGAP website, but also the FinDev Gateway website, where there's a lot of great information on everything from typhoons to Ebola outbreaks to over-indebtedness crises. But I don't think we've ever experienced a global crisis where this was happening to everybody at the same time. So I think we will be harvesting quite a few lessons from the last year. You know, obviously digital's played a really important role, and I think that's being taken up with gusto by a lot in the microfinance community. Obviously, governments have made good use of it, and some of the big systems like UPI and some of the MNOs in Africa have played an absolutely crucial role in getting help to people in need. And I think a lot of the MFIs are going to be taking up digital in a much bigger way, both in terms of managing their core operations, but also in terms of how they connect with their clients. So I think we will see pretty big changes coming out of this crisis in both the microfinance and the digital finance community. Certainly the delivery of government aid has been radically changed by this. And we've worked in countries like India, where UPI and all of the bank accounts that you've established have been fundamental in getting help out to people. We also have worked in other countries where literally nothing was in place and they had to deploy the army to get help out to people. And so, you know, I think there have been a lot of lessons learned around that as well. So I think we're going to spend the next couple of years figuring out all the lessons learned from 2020 and 2021.
With